Hey everyone, thanks for joining me for today's video. In this video, I'm going to be talking about 5 expensive Canadian stocks that are trading on the TSX. Notice how I said expensive and not overvalued. I'm going to go into what their price to earnings ratios are, how fast some of these companies have been growing, and if in my opinion, I believe like their high multiples are worth it given the growth profile and the moats that these companies have. So this should be an interesting video. If you like this kind of content, be sure to give this video a big thumbs up. It does help with the YouTube algorithm. And if you haven't yet, be sure to subscribe to the channel. We do lots of videos like this, go through lots of stocks, both Canadian and American. Okay, so jumping into the first of 5 stocks that are trading at very expensive multiples. It is Dollarama. So Dollarama, obviously the largest dollar chain in Canada, trading at $95 a share. $27 billion valuation here and a PE of about 30 times. So just looking at this company in terms of its performance, up 20% on the year, 25% in the last 1 year. In the last 5 years, this one's up over 120%. So it's done phenomenally well. You can see its longer term performance there as well. It's just been breaking out like crazy year over year here. See, it's up 10% in the last month alone. That's because they reported pretty good earnings here. Lots of new consumers are turning to dollar channels to buy more and more product categories. Since inflation and prices keep going up, more people are looking for value, and value never really goes out of style. That's something I heard a long time ago that really stuck with me. All these consumers, no matter what generation and whatnot, luxury and different types of experiences in terms of shopping can go up and down a bit, but generally speaking, value is always a big chunk. Everyone wants to get good value for what they are buying with their hard-earned money. So you can see on their report here, the shares jumped 6%. Another big driver of Dollarama is their price points went up from $4 to $5 as a cap, which really allowed them to hold a lot more product categories, a lot more products, and that act as a huge revenue driver for the company there. Looking at their earnings estimates here, so they're expected to do about $3.30 this year. So that's about 29 times earnings. And then if you go into next year, they're going to grow about 10%. So about 25 times earnings they're trading here, which is really expensive for a Canadian retailer or Canadian, like if I compare it to the grocers and companies like that. Just to look at a couple of their competitors here, you got Empire owns Sobeys, Food Basics, those kinds of companies, trading at 13 times. Even Loblaw, which also has like a credit card division and a lot of other things going on. Loblaw trades at about 18 times. So to trade up at 30 times is really remarkable. It really goes to show the growth rate they've been able to build and the confidence in their investors that they have. So $27 billion market cap. This is a huge Canadian company here. Trading at a really high valuation. So for me personally, I can see how they've done really well, but I'm not paying 30 times earnings for any retailer, let alone Dollarama. So this is one that I'm personally not interested in from an investment standpoint, but I hope that the company continues to do well. I think it's a great business, but I won't be investing here given the valuation. The second expensive stock that's trading on the Canadian market is Boyd Group Services. So this is a $5 billion company trading at a PE of about 50 if you look trailing, up 33% in the last year, 100% in the last 5, and you can just kind of see, obviously had a huge correction during the pandemic, but before that it just ramped up to 250. Now we're all the way back up there. So it was a big buying opportunity, about a double up if you bought the shares a couple years ago or during the pandemic. But right now they continue to perform well, 20% on the year. Pay a tiny dividend, but it's pretty much nothing. Looking into this company a bit, you can see on this sheet here, they primarily operate in the US. So about 90% of their business is in the US, 10% in Canada. So even though this is a Canadian company traded on the TSX, you're really buying a US company here for the most part. You can see their locations here, have some decent presence in Ontario, but other than that, they're really US dominated, US focused. They essentially run these collision repair shops. So as long as there's cars on the road getting damaged, windows getting rocks hit with them, tires getting popped, stuff like that, they'll continue to have a steady stream of business, and that's why they've been able to deliver such sustained growth, just because the category they play in is really defensive. No matter if the economy is good or bad, usually people don't choose to get lots of the services they offer. They just have to because they're moving around. And you can see as less people went on the road, less incidences, sales dropped 30 to 35%. So that was huge, but then it just rebounded right back the next year, back up, and they've been growing ever since, which is great to see. So lots of growth on this company, great track record if you look at this over the last 10 years, really sustained growth. And then even after they got that 35% back, they've sustained a much higher growth rate as well, which is great to see. Looking at their earnings though, this company is expected to do $6 a share this year. So if I times that by about 40, it would be at where they're trading right now. So about 40 times current year earnings. Looks like they're going to grow about 30%. So maybe about 28, 29 times next year's earnings. Still very expensive stock in my opinion. They do have a great track record, but at those valuations, it's not one that I'm personally interested in. So I will be passing on this one, but it's a great stock, great company that's operated really well. I just don't like buying in at multiples in the 40s or high 30s. So that is the second stock. The third stock we're talking about today is Thomson Reuters. So this is an $80 billion Canadian company, 29 times price to earnings. They pay a bit more of a dividend of about 1.5%. Looking at this one here, year to date, up 7%. In the last year, up 15%. Last 5 years, up 160%. So this one's really blown up. I believe they do media for the most part. They own a lot of assets that I'm sure we touch base with very frequently across like business news and data and stuff like that. Looking at their business a bit, you can see here their reported revenues, legal professionals, corporate, Reuters News. I thought that was a bigger part of their business. Print is an area that's actually declining. So this is one that I'm not really too impressed with their growth, right? You're getting growth of anywhere between minus like negative growth to 5%. If you give them the benefit of doubt on organic, they're low single digits to high single digits. It's not really a huge growth company. Yet when I look at their costs, they're trading at about they're making about $4.60 this year. So almost like 40 times earnings. And then next year making $5. So that's easier to do the math on. That is about 35 times earnings. So I don't fully understand unless there's like, some CapEx investment or something short-term diluting the earnings per share. But I would not pay 30 times, 40 times earnings for a media conglomerate. So without knowing too much about their business, this looks like a really expensive one that is not really one that I'm interested in either. Okay, so far 0 for 3, even though we went through some great businesses. Going on to the fourth stock here. If you haven't yet, be sure to give this video a thumbs up as we kind of reach the midpoint of it. It really does help with the YouTube channel. Appreciate it a lot. But the fourth stock here is Canada Goose Holdings, as you can see on the screen. This is a $2 billion company. You can see their 52-week range is actually $32 to $20. So it's trading near the bottom of the range in the last 52 weeks, which is really interesting. Looking at the PE, it says it's a 40 times PE here, 43 times PE trailing. And you can kind of see some of the volatility went all the way up. Looks like they probably had a good earnings report. And then news got tempered, and then they may have missed the next one based off of that drop there. But let's take a bit more of a look at Canada Goose here. They're showing how they're expected in 5 years to do $3 billion in revenue, 30% EBITDA margins, so about $900 million in margin. Right now, the value of the company is $2.2 billion. So that would be a really good number if they're able to pull it off. In terms of their business model, they do pricing annually. They are really integrated. They own their stores. They own their their suppliers in terms of the making of the product, everything else. They control their own distribution for the most part in their own Canada Goose stores. So they have that relationship with consumers. And then just everyone calls out, how great their product is. But they say they have an iconic product with the jackets here that most of us are probably familiar with. In terms of the opportunity, you see here, let's just look at some of this data. They were in 4 countries or 36 countries in 2017, 62 countries this year, and they're expected to be in over 80 countries in 5 years. In terms of D2C revenue, you can see they only had 2 locations in 2017. That's up to 51 in 2023, and they want to double it in the next 5 years as well. So lots of business going through direct to consumer, about 30% 5 years ago. Now it's up to 68%. They want to get to 80% direct to consumer channels, which, as long as they can operate it efficiently, they get to hold on to more margin, they have more control, so it's always a great thing. And then just looking at the growth rate, they're expecting a 20% revenue CAGR. So as we look at this company versus like Thomson Reuters, for instance, you saw Thomson Reuters having revenue growth 1, 2, 5% and trading at a 40 times valuation. This company here is trading at a high valuation, trailing, but they're expected to grow 20%. They're expecting margin expansion. So I get this one a bit more versus some of those other ones. So on this one here, still expensive. You still have to buy the story, but I understand why this company's trading at a trailing PE around 40. Whereas some of these other ones, I have a harder time wrapping my head around how that's an appropriate or a good value to be getting in on. Okay, going into my 5th and final stock that I've called out here for expensive Canadian stocks. It is Nuvei. So this one's down huge in the last year, 44%. Lots of people are familiar with Nuvei because Ryan Reynolds actually bought a position in Nuvei and does lots of their marketing, is featured in lots of their marketing. And they pay about a 2.3% dividend yield here, $3.2 billion company. And I think the PE is probably a bit wrong, even though it's trailing, because if they're paying out 2.5%, that means they need free cash flows at least at a 1/40th of their market cap. So about 40 times earnings from a free cash flow standpoint, assuming they're not keeping any of the cash, which I'm sure they are. But it still looks like it's a bit expensive based off of the trailing PE there, and just in terms of the multiples they've been experiencing. So looking at this business a bit, they are a Canadian company, but they operate all over the world, which is really interesting to see. You can see all their touch points here and all the relationships that they have with all the other big players in terms of the payment ecosystem. And then lastly, similar to Canada Goose, you see some huge growth numbers here. Volume increases 68% in the second quarter. Revenue increase of 45%. You can see just huge numbers. Even organic revenue, excluding digital assets and cryptocurrencies, was 20% growth. And that excludes lots of areas that obviously had growth because their whole revenue is 45%. So this is what I like to see from a company. If I'm going to buy a company with a high price to earnings ratio, anticipating that it's going to grow into it and get me a great value in 1 and 2 and 3 and 5 years from now, I really like seeing at least getting these double digit, in the case of Canada Goose at 20%, or high double digit, like these 50, 60% growth rates, to make it model out that the future opportunity is worth giving up a starting dividend yield of 4%, 5%, 6%, or other investment opportunities that you may have in the stock market or in other areas. So on Nuvei and on Canada Goose, I get it. Dollarama, just steady, very developed company, performing really well. So to some degree, I get it, but still too expensive for a bricks and mortar retailer for me. Boyd Group, they have just a really good history of performing well and delivering shareholder return in a category with demand that's going to continue and a bit of a moat. So still think it's too expensive for what it is. And then Thomson Reuters is probably the one out of these 5. I may not fully understand the company, so forgive me or educate me in the comments, but I don't see why a media company or a company that's growing in the single digits and in this space would demand a multiple that this one's trading at today. So that's kind of my overall thoughts on these 5 stocks that I'm characterizing as expensive on the Canadian Stock Exchange. Would love to hear your thoughts though. Let me know in the comments. Like I mentioned before, if you haven't yet, be sure to give this video a big thumbs up. I'd really appreciate it. And consider subscribing to the channel if you haven't already. Thank you guys so much for watching, and I'll see you guys in the next one.